What's
Good
going
morning, Tim Quast, founder, CEO, Market Structure Ads. Got a nice smile on your face this morning. Tim, how you doing?
well, top of the Monday morning, you sages of the screens. Nice to see you guys.
Yeah. Okay, well, we came off an options expiration. Let's get right to it.
Yeah.
And I know like one of your favorite things is see the options roll off the board on Friday. See what we can learn from
Mhm.
that and all those puts going off the board, all those calls going off the board worthless, and maybe some of the puts that you didn't time it perfectly. But what can we learn? And couple that with comments from our buddy Jay Powell.
Well, that's a lot, Joel. To me, the big lesson for traders is to be aware that when options expire, stocks may not do what you expect, and the markets might not either. You don't hear much about options expirations in the business news. It's all about earnings and corporate news and so on. And so we're influenced by that as traders, and we just think that every day that is a new day in the market and we start from zero. And that's not really how the market works. The options expirations periods are very telling about what the direction hedge funds are going. They play a key role, particularly around earnings reports. How global macro money, which is trillions of dollars, it consumes data and repositions. And so it's, to me, if you look in the rearview mirror, what might you have done differently as a trader if you had known that? Well, I'll tell you how I think about that. I look at options expirations as the wild card. We don't know what's going to happen, so we have to juxtapose the right but not the obligation to do something with an option with what are the central tendencies in the broad flows of money, which I think of as passive investment. Because passive investment waxes and wanes, and it's much larger than earnings, folks. It's really easy to think that earnings are the crucial turning point in the markets. No, it's whether people are committing money to fixed income or equities. Are they in growth? Or are they value? Are they large cap or small cap? And 95% of assets are in large cap, by the way, not small cap. Small cap struggles because there isn't enough money chasing those goods, and you should know that. So when I look at it, I was happy that every opportunity to trade long when the market pulled back, I used. And it was a good trading week for me because I knew why things would go down, and yet the probability was that anytime the market dropped significantly, it would recover some. And so that's how I like to look at those two things around options expirations. You have to really shorten your time frames, though.
All right, Tim, let's take a look. Of course, the market was falling last week. We fell like 3 consecutive days. Let's take a look at what is going on underneath. What is the quantitative look here for the market? Because, of course, if you just take a look at the price action, I see people in the chat. Everyone seems like it's back to bear market days. Let's take a look at what the stats are saying and how demand and supply adds up here.
Yeah, if you're part of the edge mob, and you're new to it, you might say, well, broad sentiment was rising, and yet the market declined. So surely the data must be wrong. And no, it still gave us the central tendency, and that's the core thing. When I use that term, central tendency, what do I mean? I mean, it's a mathematical term. What should be our general expectation? It's not perfect. It is not precise, but it is a good way to think about the market. So apologies, I had to reset this. So here's what I mean about the central tendency. The central tendency is the green line. The central tendency is, call it 88% of market cap. It's roughly the S&P 500, it's SPY, but this green line is the composition of all the stocks comprising the S&P 500 and their supply-demand balance. All the buying and selling by investors and traders normalized to a 10-point scale, and you can see what it's doing. So the central tendency into options expirations, there's those little green squares that tell us options are expiring, was up, and yet the market was down. It is very similar, really, to what happened at options expirations in September. But because this demand side was up, there was opportunity every day to make money long. every time the market pulled back, the volatility of SPY, which is about 1%, 1.1%, the underlying stocks are about 2.3% volatile right now. But you could just think about it this way. The derivative, SPY, the ETF tracking the underlying stocks is 1% volatile, and the stocks themselves are 2% volatile. That's the trade. So if the broad measure pulls back 1%, what is the probability intraday that it might get some of that back? Well, with that uptrend in overall demand, very high. And I did it every time that opportunity presented itself by trading SPXL. I'm not suggesting that you do that. You have to be very confident in what the data are telling for you to do that, but it's an effective way to produce short-term returns. Each time you can produce 1 or 2%, take that money, start over, wait for the volatility to give you another entry point. And the way that you know that that's likely to happen is the demand side. And if I scroll down, the supply side. So if I know supply is rising and demand has been weaker or supply has been shallower, what happens when those things diverge? Well, you're going to get a trading opportunity. The reason stocks didn't rise is options were expiring. All that implied demand, 20% of it resetting, and you don't know exactly what's going to happen. But that's how I think about it.
So this is a difficult day. In other words, once the options are gone here now, they're gone. Obviously, we've had the third Friday here. So how do you approach the Monday morning after the options are off the board?
Well, it's a very, very good question, Dennis. So new options trade today. So we're starting over. And people who came through that lost money or made money. Global macro money that hedges its exposure is going to increase or decrease, or maybe it rolled its hedges, but we don't know. And there are, everybody, it could be you and I selling volatility to keep a premium. But there are big banks that dominate that market. 5 big banks dominate the market for derivatives. And so did they prepare properly? Will demand meet supply? We don't know. We have to watch how that unfolds. I'll tell you something that concerns me or has the potential to be concerning. If you look at the last 2 times, here's August options expirations right there. And demand was falling and supply was very high, and the market declined into options expirations. Then supply came down because the banks knew there was an imbalance. So they short to cover their own risk. Then as the new series trades, they covered and the market recovered and up went, in this case, SPY, but the whole broad market went up. Then we get to September options expirations. Demand was declining, supply was very high, market plunged, and then everybody covered. Now, where are we this time? Well, it's really interesting. This is the first one out of 3 where demand is not declining. And that's in some ways worse because if now demand declines and supply rises, we will add to the downside. I'm not saying that's going to happen. The thing I'm going to watch is this. If the supply side declines, we're fine. Probably the market slips a little bit, but then gets its footing. If it doesn't, if this rises and demand falls, we could see the market take another step down. And I can't tell you what it's going to do. I tell you, I have a short bias now. I will do the opposite of what I did during options expirations, where if the market declined, I bought long. Now, if the market rises, I'm going to short it, because the central tendency here tells me that we have just about, this is probably the peak. I mean, if you trend lined that, it would be tailing over. So I don't know what's going to happen. I'd be curious what you guys think, but it's different than the last 2 times where the market bottomed after options expirations.
We had a guest on Friday talking about the VIX, right? And the and in some element, is the VIX broken? I mean, we look at, we're trading here at 22, we're up 42 cents. I look at the last the last hour of trading, which was volatile, the market's getting hit. I mean, people have to be very frustrated here being, long the VIX and the VIX instruments. If we were at this, this major turning point of a really big major down leg in the market,
right?
The VIX certainly isn't giving us any cues to that.
I agree, Joel. I am a VIX naysayer. I'm not a fan of the VIX because I don't find that it's predictive. I prefer something that tells me what's coming rather than tells me about what's already happened. The problem with the VIX is
You
it
can tell I
doesn't
like
move.
that comment.
Right? I don't use nor rely on the VIX for anything because it's not. It doesn't help
Thank
you. It
you.
doesn't protect you. So
Lags, lags,
Yes,
Lags.
lagging
Right.
indicator.
super late
Right.
indicator.
Piling on.
Super late.
Piling on
Oh
the
my
VIX.
gosh, the VIX is at 30. I better sell
Good
stocks.
Lord.
What are you talking about? We just fell 25%. That's why the VIX is at 30. That thing
I'm
lags.
glad
VIX
we-
is a useless,
Hold on.
useless indicator.
Hold on. Do
good-
we all four agree on something?
Oh,
We don't-
no.
That's a scary
No,
thought. The
that's-
VIX is all of a
oh,
sudden
there-
become a useful
Is that
indicator.
a bearish or bullish?
Oh my
signal?
I don't
gosh.
know, man.
Right,
I
it's,
don't know.
I tell you, if you had the Joel Dennis VIX right now, it would be like off the charts right now. I mean, it would be like, you know,
Be traded like GME right now.
it'd be like, holy, we would have to do intraday splits to get the price down. I mean, so, okay, just, all right,
a
Tim,
good friend
I mean,
of mine, good friend of mine says, tell me what the difference between a lagging indicator and a consequence is. That's a good line.
Ooh,
Right?
that's true.
Right? What's the difference between a lagging indicator and a consequence? So they're the same.
Exactly.
Anyway, yeah.
Happens
so
after the
before we let
fact.
you go,
Right.
before we let
Yeah.
you go, I mean,
Yeah.
you know, we like to look at both sides of the market here.
Yep.
Obviously, you know, one side of the market's being predominant here. What should people what should they look to trade? What could turn us? You know, what could turn us here where maybe old Tim would be a little bit more friendly to the bull side?
Yeah, well, I can give you one quick answer. This is big tech. So this includes the Magnificent Seven plus several others. I like
Okay.
to trade AMD in this group because it will give you more volatility with the same characteristics as the Magnificent Seven. And I traded it very successfully the last couple of weeks. I was stopped out of it on Wednesday, I think. No, maybe it was Monday. At any rate, I didn't own much of it anymore, and it was immaterial to me. But look at this. This is what has to change for me to say, oh, everything's good. Look at the demand side in big tech and the supply side.
Coming down.
You short convergences. So it will surprise me if any of the big tech that is slated to report results that you were talking about, Dennis, later this week, if those stocks perform well. You know, I'm not saying that's the case, but I look at this and the central tendency is that money is trying to reduce its exposure to big tech. Big passives are overweight. And remember, back up 9 months ago, everybody hated Meta. Then now it's like the best stock ever.
No, I know.
Well, that's how things go, right? So this would have to change. This would have to come down and demand would have to recover, but that will take a good minimum 2 weeks. And it might be the other side of the end of October, which would be that long.
That's
so this
such a
is what
great
you
point.
need. Yeah.
Like 1 year ago here, we had Jim Cramer on CNBC when Meta fell under $100 and said, I got this wrong. You know, this company just cannot figure it out. I got this wrong. And the company turned around and ran up 200% after that comment. And, you know, and now, you know, Jim Cramer's talking about how he got Meta right, you know, and obviously pats himself in the back when he's wrong. You know, and the stock has been an unbelievable performer here, but he's a good feel for like Cramer, you know, talking, obviously he's a good feel for like consumer, what the retail trader is thinking, you know, and they all like washed out of it at $100 here. And now they all love it at $300 here. I mean, they're doing it backwards.
Right. Exactly. Yeah. Yeah. Here's where you want to buy tech. You know, it was October 2nd is when we all went long tech. And why? Because the demand side bottomed and the supply side was falling, and demand way outstripped supply till now. So if you're in big tech, get out. Just take your gains. It doesn't mean, you know, the stocks can't go up or down and move things around, but just take your gains and wait for those conditions to change. The way that you beat the benchmark is you buy and sell at different times than everybody else. You're going to own the same thing as everybody else. That is a fact. There are 500 large caps, mega caps, 300 mid caps that comprise 95% of market cap, 800 stocks. That's it. All right, so we're going to own the same stuff, and the only way to win is to buy and sell them at different times than other
True.
people, and generally shorten your time frames, folks. Buy and hold does not work. I'm telling you flat out, because the market is too volatile. If you need the money at a particular moment in time, volatility is your enemy. If you trade short term and take your gains, volatility is your friend. But you have to change your thinking, and it forces you to reject orthodoxy. And it's not a problem with the basics of Benjamin Graham investing. The problem is the stock market doesn't favor those things anymore, and you have to realize that.
All right, Tim, we're going to let you go here. But before I let you go, I'm going to give you a marketing slogan. Okay.
Oh, let me write this down.
And you don't, I don't know how much you're going to have to pay
Hold
me
up.
for this. Are you ready?
Okay, let's
Joel wants
hear
a
it.
kickback.
Are you ready?
Okay, all right.
Stay off the ledge with market
Stay off the
structure
ledge.
edge. With market structure edge.
Stay off the
like
ledge
it.
with market
I'll tell
structure
you, that's
edge.
pretty-
Joel loves
pretty
giving the
good.
slogans away.
Thanks, Tim.
Or
Good to
fall
see you,
off the
Joel.
ledge without market
Dennis.
structure edge.
Oh,
Hope
look
you
at
have
that.
a
Money man.
parachute.
We can do this for another half hour. Tim,
Yeah,
we
all right,
love
we
you.
better
We'll
stop.
talk